Hello friend, hope you are well. Welcome to another video in our series Finance and Investing Tidbits. The theme of this video, how is the concept of ROE, which is return on equity, different from the concept of ROCE, also called as ROCE in some companies, which is return on capital employed. Welcome to this video. Return on investment is a very important measure of company performance, as it sums it all in the form of the investment which has gone into the business and the profit which has been earned out of that investment. Both ROE and ROCE are measures of return on investment. In fact, the concept of return on investment can be defined numerous ways, and you will see many variations of return on investment. But two of the most commonly used definitions are ROE and ROCE, and they're very widely used, and we are going to discuss exactly those two in this video. ROE, return on equity, is an important measure from investors or shareholders' perspective, since it measures return on their investment in the business as per the books of accounts, the financial statements. Return on equity ROE is derived by dividing the PAT, the profit after tax or net profit, by average or year-end equity. Wherever average data is available, we should surely use it. If that data is not available, we can use year-end data. If we have two year ends, we can also take an average using that. If we have quarterly data, we can take a quarterly average. Averages obviously represent the fact better, but if you don't have averages, we can use the year-end data. Return on capital employed is derived by dividing EBIT, earnings, which means profit, before interest and taxes, that is without considering interest and taxes. That definition of profit is used, and that's divided by capital employed, again average or year-end. Capital employed is the sum total of equity and long-term debt. So naturally, we are looking at a wider definition of investment, and naturally, we are considering profit before considering interest. ROE is calculated for the company as a whole. ROCE, on the other hand, is calculated either for the company as a whole, or it can be even calculated for segments or operating divisions, as it is called. ROE's focus is return from shareholders' perspective. ROCE's focus is more on operations, and therefore, when we focus on operations, it doesn't matter whether the financing is done out of equity or debt and what is the mix, and therefore debt and equity is together considered as a source of capital, and therefore the concept of capital employed includes both equity and debt. So in that sense, ROCE or ROCE is neutral to how the capital structure has been used in the form of equity and debt proportions, right? And naturally the focus is more on EBIT, which is the profit before interest, and naturally it's a completely operations focused number. ROE, because it is calculated using post-tax, profit is calculated on a post-tax basis, and ROCE on the other hand is calculated on a pre-tax basis, because EBIT or PBIT, earnings before interest and taxes, or profit before interest and taxes, which are synonymous terms, it is by definition before interest and taxes, and naturally return on capital employed is on a pre-tax basis. In the Indian context, the thumb rule for both of them, ROE and ROCE, is 20%. But remember, ROE is on a post-tax basis and ROCE is on a pre-tax basis. Now, ROCE also has a 20% threshold because the cost of debt is much lower than cost of equity, and therefore, if considering that ROCE is based on capital employed, which is the wider definition of capital invested in the business, which includes debt, we are looking at a pre-tax number, and yet the threshold is kept at the same 20%. Thank you for watching this video, and do subscribe to the channel and share the videos that you like. Thank you.